Here
to
we
get the bedtime routine going.
Yeah. Namaskar. Welcome back to another Thursday live evening, 7 p.m. on YouTube. So if you're watching, you're new here, then my name is Aditya Soma, and I use this lives to share some information about real estate and answer your questions, whatever the questions you have related to real estate. It could be investing, it could be selling, it could be buying a primary home. Whatever your questions are, this live is for you. And always, every week, I try to bring a guest as much as possible who is expert in their own areas, who can add value for us, for us, I mean, who are looking to buy investment properties, uh, get financial freedom through real estate. So today I have a special guest for you guys. If you don't know, who you're seeing on the screen, a good friend of mine who, probably I think I had him on the live before,
Yeah,
or on the video. I don't remember exactly if it's the video or the live, but it's a. I would say I call myself fortunate to meet this wonderful person who helped me to get my multifamily financing, and who has years of experience in banking sector, and now turned into a mortgage broker, mortgage agent, or mortgage agent specialist, however I call it, and who helps most of my clients, get funding through CIBC. So, brother, welcome, and thank you again for your time.
come on. Thank you, man. Thanks for the platform. And obviously, more than anything, I enjoy your friendship and we've been doing some business together. That's always good. Helping many clients, become first-time home buyers or buying their first investment property. It's always exciting to partner with you and help these people achieve their financial goals of home ownership or investment property ownership. So you're doing some amazing things, and as always, a pleasure to be part of anything you and your team are doing.
Thank you. And the reason I asked you to do this live, because biggest thing now, the hot topic in Canada and US is what the heck is happening to this mortgage rates, and how the Silicon Valley Bank, bankruptcy, and then I think another bank filed a bankruptcy. How those things going to impact us, in Canada. So that's why I thought, I cannot think of anyone else better than you, who is into this industry, who might have some insider insight that you can share with us.
Yeah, absolutely. I mean, you know what? We can definitely. I want to talk about the Silicon Valley Bank for sure. Kind
Mhm.
of what happened, what led to the bank run, and how does that impact Canada, or what could that happen in the Canadian banks? Right, I'm
Mhm.
getting that a lot of questions around that. Right,
Yeah.
so I'll talk a little bit about what happened in the Silicon Valley Bank, just very quick, high level. Right,
Mhm.
so generally, all banks, what they'll do is they'll take clients' deposits. So clients like yourself, myself, all the deposit money, and they tend to loan that money out.
Mhm.
That's usually what banks do, whether they buy other assets or they loan it out to other customers, right? And they earn interest on that, or their asset values grow. With the Silicon Valley Bank, what they were doing was they had taken their funds, and
Mhm.
it's not like anything like 2008 where they had bad loans or had lent money out to clients who couldn't afford it. It wasn't anything like that. What they had done is they had taken a large amount of their deposits and they had invested it into the bonds in the US. And so bonds are usually a safe investment. They're not a bad thing to invest in.
Mhm.
But when you invest a lot of money in bonds and the interest rates start to go up, that's not good for the bonds that you've purchased. And that's pretty much what happened with the Silicon Valley Bank. That's not all bad by itself if the bonds are not performing, but when a lot of customers come to the bank and try to take all the money out and all the money is invested in bonds and now it's not worth what you thought it was going to be worth, but people want to take their money out, you have to sell those bonds at a loss, right?
Mhm. Yeah.
So that's what happened. What happened was the Silicon Valley Bank. took billions of dollars. They invested in the bonds, and when the bond value started going down, it was almost like the word got out, and customers said, "Hey, I need to start taking my money out," but they didn't have enough money on hand to actually give to their clients. And so when they had to sell and liquidate the bonds, they took a massive hit, and they couldn't kind of survive that, right? And that's what happened. There's a big difference between Silicon Valley Bank and the Canadian banking system. And so if you think about it, if you're like a regulator, or if you're working in the risk management department for Silicon Valley Bank, probably not the best decision for them to go invest in bonds, short-term investments with long-term loans, and their short-term investments failed pretty much. So they don't have enough money for the long-term loans or to give their clients their deposit back. So I'm going to stop for a second. It's a lot of information I was kind of sharing. Maybe you want to ask some questions around that, or I can elaborate further.
I got that idea from what I read about their story. But what I'm really concerned about is how does our banks do? Do you have any insight on how Canadian banks invest the money, the deposit, the customers' money? Is there any kind of red flags that you're aware of?
Yeah, so fundamentally, we're very different than what happened with the Silicon Valley Bank, right? So the Silicon Valley Bank was primarily like a venture capital bank, okay? And Canadian banks are not like that. So a lot of the deposits the Canadian banks get are from clients like myself and you and all the other customers. So the deposits per client is much smaller. The deposit on a Silicon Valley Bank, for example, would be coming from a tech company from California. And that tech company is gone public and has a bunch of, let's say venture capitalists who buy those shares and are depositing like hundreds of millions of dollars at a time. So the bank was new. It grew very fast because it had many large deposits, versus the Canadian banks have been around for much longer, and the deposit have not come fast and furious. So that's not fast and furious. So that's one of the biggest differences, is the deposits that are built in the Canadian banking system have come over a very long period of time, and they don't come in large sums like they were coming in for the tech companies in the SVB, where in SVB was a lot of the deposits were coming for tech companies. And they had so much in deposits that they didn't have enough loans to give out, so they started investing in other things like the bonds. So in Canada, the banks actually, like the Bank of Canada, I believe right now has $200 billion in liquidity. So huge difference. Where they didn't have that type of liquidity. So we're much more conservative, and we're way more heavily regulated than it is in the US. Like the US is over 2,000 banks. Or Canada, it's not as many. We have like the big five.
Big five, and all these big fives have been around for at least 100 years. Many hundreds of years. CIBC bank I work for over 150 years. Been around. So totally different system, totally different regulation system. So that's one of the biggest differences. In order for the Canadian banking, if something happened like this in the Canadian banking system, it would be much, much worse because we're all pretty much like one big bank, right? So don't necessarily operate in silos like SVB Bank or some of the other banks in US. We're much more like one large bank, right? So the chances of that happening are lower, much lower, like something like that happening in Canada. That's good to know, especially from someone like us, like you said, who uses the bank for day-to-day basis, not put all the millions of dollars in there, but who borrows money from the bank to get primary homes and all those things, because I think there is a interconnection. If the bank goes bankrupt, now what happens to my mortgage?
So that's a good question. So let's say if you're part of a mortgage company in Canada, right? So there are many mortgage companies in Canada. I'm not going to mention any because I don't want to say anything negative. But there are many mortgage companies that are not banks in Canada. And let's say, for example, you're a mortgage, you're a client that has a mortgage with that mortgage company, and now that mortgage company is, failing, and it's going to get acquired by another bank or another mortgage company. If you're a mortgage client, what would happen is your mortgage, for example, let's say it's at 5.5%. Okay. Now that your mortgage company is failing, now your mortgage security has been purchased by another organization. That organization will take over your mortgage business, but they will give you a new set of terms. Okay. So for example, if you have, let's say, a 5.5% mortgage, and then they're transferring to the new mortgage company, they could say, hey, you know what, this is a little bit high risk lending. We're not comfortable at 5.5%. We are going to increase the interest rate to 6.5% or 7.5%. They will get to kind of choose that term. So you're thinking, okay, I don't want that term. I don't like that term. So what happens to you in that situation is you would have to try to refinance with any other organization, but you would have to refinance at the current rates with the current stress test levels. Yeah. So if you were approved before with the lower interest rate, you may not qualify to refinance at the current levels. So you may be forced into taking that new mortgage company's terms. And that's one of the things that, that's one of the benefits of maybe going with a larger mortgage company or a big bank is the chances of something like that happening are even smaller.
And what if, you lost your job while this happened and now you don't qualify? What would happen in that situation? Now you just bankrupt, or?
No, you're forced to take that higher interest rate, right? You're forced to take on the terms that the new organization has laid out for you because you don't have any options to requalify, right? Gotcha. And so sometimes, there are mortgage companies that also invest money in other businesses, and if they invest that money incorrectly, or if they invest in the incorrect assets, they could also fail. And so, which mortgage company you go with can be extremely important as well, because if you end up going with a smaller organization, they maybe have a higher chance of something going wrong than, like we mentioned, some of the larger banks or larger organizations. So this SVB is like a good way of showing like what could happen, right? In that situation.
Yeah, no, that's one reason why I see, the mortgage companies that are not the big five usually offer some kind of discounted rates comparatively, but also there's a lot of restrictions on them. You cannot refi at certain points. Probably what are the things that I should look when I'm an investor to avoid this kind of issues, or let's say, because this is I'm bringing back to the day-to-day usable
information.
Exactly. So the common things that I see day-to-day basis, like I'm a first-time home buyer. Now I'm looking at I got my property under contract. I'm deciding which lender to go with. Here Big Five offering me 5%, but maybe I don't know what those other companies. I never worked with them.
Sure.
But pick one. Any?
Yeah, sure. Like I'll tell you what things to look out for, right?
Yeah.
Like as a consumer, what do you want to look out for? So first few things that you want to check is, are there any fees associated with this? When you're working with larger organizations or banks, there are no fees. There's no fee to a client for applying for a mortgage, getting a mortgage, anything like that, right? When you start working with some brokers or some other institutions, there could be lender fees, broker fees. So you wanna understand that up front, and you don't want to be surprised by that near the end. So that's the first thing. Some of the lending companies also have restrictions like prepayment. You can't make any additional payments on your mortgage. So think about it this way: where you have a mortgage interest rate that's low, you want to take advantage of paying your mortgage off before the rates go up. And some of those companies have restrictions around that. You can only do so much. You can't do 10%. You can't do a lump sum payment either. It's not a transferable mortgage. So if you wanted to sell your property and move to a new property, you can't port or transfer this mortgage. Where obviously with the bank I work with, which is CIBC Bank, we allow you to do all of those things. You can make lump sum payments. You can increase your monthly payment to pay your mortgage off quicker. You can also, if you sell your home, you can port or transfer your mortgage to another property, right? So those are some of the things to look out for. There
And
are
with
a
the
lot
same
of
terms, like,
restrictions.
so let's say I own, this house that I'm living in, and I have a interest rate of like 3% something. Now
Mhm.
the mortgage is like 300,000, and I'm going to buy another home for 600,000, and I need a mortgage of 500,000. I have
Yeah.
this old mortgage that is 300,000 with an interest of 3%. So you guys allow to me to use that same term, same terms on that 300 and get the new loan for the remaining?
Yeah, so good question. Yeah, we allow you to transfer. So you have old money at 3%, right?
Mhm.
And now you need to borrow $200,000 at the higher interest rates because they're higher. So what we actually do is we transfer your mortgage to the new property, and we
Mhm.
blend your interest rate. So you have the
Wow.
old money. You have the old money at 3%. You have the new money at let's say 4.8 or 4.7%. We
Mhm.
blend the two, and you're probably going to end up in mid to high 3%, which is still significantly lower on the whole $500,000, still
Yeah.
significantly lower than what the current interest rates are. It can save you hundreds and thousands of dollars, right?
Yeah,
So
that's a very good thing. I'm not aware of that. Probably it's a
yeah,
surprising, like if someone is, upgrading their life and they bought a property like 3-4 years ago where the rates were damn low.
yeah,
Now, you're selling that property, now moving to another one. That's a very good thing to
yeah.
know.
Not
And
not,
also,
not only
go
not,
ahead.
not only that there you can also refinance. So
Mhm.
during that period of 4 or 5 years, let's say you locked in your rate for 4 or 5 years.
Mhm.
During that time period, if you need to, let's say, refinance for any projects, or you're looking to refinance to take any equity out of your property, you can refinance without breaking that mortgage term. And same thing, we would blend your interest rate so you're not
Even
paying a
if it's a
penalty.
fixed rate.
Correct. You're not paying a penalty. You're not paying a discharge fee or anything like that. We're simply blending it in with the new money and the new current rates. So you can do all of that within your term, within your 2-3 year term, and you don't have to worry about transferring it or breaking it. And you can still
Mhm.
take advantage of your property value going up.
Yeah.
And a lot of times people want to renovate, so your
Yeah.
value goes up even higher.
Or
If
buy
it's an
another property.
Yeah, if it's an investment property, if you want to buy an investment property, absolutely take your equity out, use that for down payment funds to buy an investment property or upgrade, like you were saying. You want to sell transfer. So that gives you. We have all those options available.
Yeah, that,
Um,
that sounds like music for many investors like me, because now if I have to refinance with that company that doesn't have option to refi, now I have to go with the whole amount with a new company. Now I have to pay the penalty. Now I have to
yeah,
pick the new terms, where the interest rates are higher.
mhm,
That saves like thousands of dollars.
absolutely. It's not only that, it's very convenient, right? Like
Yeah.
you're already with the company, you're already with the lender. You probably already have a relationship with your mortgage agent, so it just makes it so much quicker. It's way more streamlined, right? The communication is a lot more clear. So yeah, and we can get something like that done. Just to
Yeah.
give you like a timeline from you and I speaking today, we could have the funds advanced as quickly as 2 weeks. So you would have the money in 2 weeks from now.
Because you
So
already have a profile established, you might just need to get
exactly.
some updated documents. It's much easier and quicker.
Yeah. Yeah.
Let's take a quick question here before I ask
Sure.
my questions, because I always have questions.
Yeah, for sure.
uh, Anji here, my good friend here, asking a question. Hi Aditya and Pritesh, hope you're doing well. Can you still use the home equity as a down payment to buy the another property?
Yeah, absolutely. So yeah, you can definitely take your home equity. You can have a home equity line of credit. You can also use that. Does it affect your debt to service ratio? Yes, it does. But usually what I recommend is in this situation, you consult your specialist, and they'll give you advice on what's the best way to take the equity out, right?
Mhm.
Does it make sense to take the equity out in the form of a line of credit? Or does it make more sense to take the equity out and attach it to your mortgage? Which will have the lowest impact on your debt to service ratio? We
Yeah.
also have different guidelines. When you have a balance on a secured line of credit, we actually have different guidelines on what type of payment we use for that debt to service ratio. So, good question. It does, but usually you want to talk to the specialist to get the best plan put together, which will give you the biggest or highest purchasing power for your next property. That's always the goal. We want to try to give you the
Yeah.
best option.
And so, correct me if I'm wrong here. So, this one might change from bank to bank, even within the big five banks. So, for example, if I have so right now I have a good size home equity line of credit on my primary home,
Mhm,
um, 300,000 home equity line of credit. But let's say this time I used it because I'm an
mhm,
investor. I always use it.
mhm,
But let's assume I haven't used it. I have 300,000 just sitting in my home equity line of credit, and I'm going to buy another property. I have money for that. I'm not going to
mhm.
use from my home equity line
Yeah.
of credit, but having this home equity line of credit impacts my capability to purchase.
Good question. So yes, it does differ from institution to institution,
Mhm.
but we always have a way to communicate with our adjudication team on how to overcome some of those challenges. But overall, you're looking at your total exposure to credit. That's one of the things they'll look at, right? We
Mhm.
want to make sure that you've got this $300,000 secured line of credit. If we don't take it into consideration and we lend you just kind of assuming it's not there because there's a $0 balance,
Mhm.
in the event if you ended up leveraging that line of credit, are you still going to be able to service your overall debt, right? And that's part of some of our due diligence that we have to complete when the file is being underwritten, right? So it could be different from institution to institution, but again, we do have methods of calculating that $300,000 payment in a more client-friendly manner, which will allow you to still buy that property, right? There are different ways to structure the file, and that's why if I wish I could just say, yeah, I don't, it's not going to work for you, but
Mhm.
there are always exceptions we can try to make, and it's case by case.
Yeah, because the reason I'm asking, I was talking to a couple of my clients recently. One
Mhm,
client precisely, this person had a primary home that's worth like $1 million. They only have a
mhm,
loan of 100,000, and I was suggesting them, like, why didn't you just refinance and have a
mhm,
equity line of credit, or you don't even have to refinance if you're with a big five. Maybe just put a home equity line of credit and use that when an opportunity present. But they were like, oh, my mortgage guy said, if I do that, and if I try to buy another property, they will reduce my buying power because
mhm.
I have, like, 700,000 equity home equity line of credit. And I was confused, and then I spoke to you, and I spoke to other people. One lender said no, they won't consider that debt, that if they are not using it, they're not going to consider. And then
Mhm.
as some people said no, we do use, but it's like you said, exceptional basis. There might be
Yeah,
a different scenario.
yeah. Generally, like for the most part, we do take that line of credit into consideration because, like I said, you have to look at exposure to credit as
Mhm.
one of the risks or risk mitigators. If you
Mhm.
have a lot of exposure or access to credit, potentially that could turn into a high risk situation, right? Something like if you got hurt and you're unable to work or unable to have the same level of income, and you have maximized all those lines of credits, and we didn't take that $700,000 line of credit into consideration,
Mhm.
it could put you in a financial jeopardy, right? And so, we definitely want to apply like sound underwriting fundamentals to every file. But again,
Mhm.
sometimes it's case by case. I have seen it where they go back and request a reduction on the secured line of credit
Mhm.
to bring the ratios in line or to bring the file within the risk appetite for an approval. So we always make recommendations. But yeah, you want to definitely talk to your lender if you're planning on buying a property. But yeah, and the rules are constantly changing. That's the other thing right now. You
Yeah.
know, they're constantly changing. So you have to be able to pivot from your original game plan. You have to be able to adapt, and you have to remain kind of versatile in this type of environment with interest rates going up and down. Bank of Canada, putting out new policies, new regulations. So nothing's set in stone. Something that's good last year may not be good anymore this year.
Yeah, that totally makes sense. Again, that brings me to the next question that I have. And by the way, guys, if you're watching, if you have any questions, don't hesitate to ask. This live is for you guys. Any questions that you have in your mind, don't let it stay here. It's going to cause you stress. Rather, just ask people. We might have some solutions, or we might have some, at least ideas to give you, to make you think the options that you are not thinking of. So don't hesitate to ask. So going back to my question here before we take the other comments,
Mhm.
how are you? What's the projections that you're seeing with this current interest rates? Where they are and where do you see they are going? Do you see
Yeah.
any potential increase in the future, or do you see any decrease, and why?
Yeah, the most
The most,
popular question. What do you think is happening with the interest rates? Um,
yeah.
I wish I could say I'm an economist and I know all the answers, but all the stuff I'm reading and all the research I'm doing, currently, obviously, we had our rate pause, which was great.
Mhm.
There's another announcement coming on up in April. I still believe that we're going to stay paused. Compared to the previous few months, overall, there is more Canadians are feeling better about their financial situation because of the rate pause. And so it's actually given some buyer optimism. You're starting to see more clients entering the market, more clients coming in for a pre-approval. If I were to guess how this is going to end, I believe that potentially by mid or end of next year, we may hit around 4.5% in interest rate. So we may be going back down to that, and that may be a good base to stay for a few years to balance out the market. So that's where I potentially see it happening in the immediate near future. The variable rate most likely not going to be coming down. Fixed rates did come down last week. So, you know, 2 weeks ago versus last week, the Friday the rates came down. And I texted you Friday morning. I'm like, hey,
Yeah.
rates are down 20 basis points. So on all fixed mortgages, the interest rate has dropped 20 basis points as recently as last Friday. And so that's something to watch.
Mhm.
The fixed rate is probably what you want to keep an eye on. And it's an extremely competitive market right now in the fixed rate.
So, like any consumer, I would ask you the question here.
Yeah.
If I'm a first time home buyer, what's my fixed rate?
Yeah, yeah. So if you're a first time home buyer and there are different offers for 5 year fixed, 3 year fixed, but you're probably going to be anywhere between 4.84 up to 5.2%, depending on what product you go with, right? Um, what should you go with? Should you go with a 2 year, 3 year,
Was
or
about
4 year, 5 year fix? That's the next question. It comes down to your comfort level.
Mhm.
I have clients that are very risk averse. They
Mhm.
like to know what their mortgage payment is. They don't want to worry about it. It's gonna be stressful for them. Then maybe you want to go with a 3, 4, or 5 year fixed, right? The higher number of years you go right now, so the 4 and 5 year fixed are lower than the 2 or 3 years. The spread
Gotcha.
is smaller on the 2 or 3 year fixed. So if you're going to go with a 2 or 3 year fixed, assuming that the rates are going to be lower in 2 or 3 years, you're going to pay a little bit higher, but that's what you're paying because you want to try to take advantage of the lower interest rates when they do come down. You're going to pay a little bit higher right now, right?
Mhm.
So just comes down to your comfort level. Every client is different. The questions we ask is, how would you feel if your interest rate went up? Those
Yeah.
are the questions I ask. You know, how will you feel if your mortgage payments go up? Are you comfortable with this mortgage payment? Yes, I am. Are you looking to decrease your mortgage payment by $100 or $200 a month? Will that be life altering for you? No, then maybe you want to go in with a 3 year fixed term. But if you're really focused on saving that $100 or $200 a month, then maybe you want to go with a 2 year term, right? So just kind of depends from client to client.
Yep. And so, also another common question that I get: will there be an interest rate difference if I'm buying a property that for personal use versus buying a property as an investment?
Yes. So usually across the board, whenever you buy an investment property, with the purposes of obviously it being a rental property from day one of owning the property, you do pay a rental. We call it like a rate premium. So it's usually 0.15% higher than what the rate would be if you're buying your own primary residence, right? So that's with my bank, but it could be different from bank to bank. And sometimes we are able to request to have that waived, but again, it's case by case. But to answer your question, yes, the rate is generally higher. It's about 0.15%, so 15 basis points higher than what it would be if you're buying a primary home.
Gotcha. And what's the prime right now? Like, so what's the prime rate?
So the prime rate for the bank right now is 6.7%.
And what's the variable rate if I'm going for like a primary home?
Yeah, you're probably gonna land anywhere between 6.05 to 6.35%. You know,
Wow. So it's
so it's
almost
in this.
1% difference.
Yeah, absolutely. The spread's there. So on the variable, that's why, for the next, little bit, the variable is not going to be coming down, right?
Mhm.
You know, like to give you an idea, between let's say 2020 and 2021, I would say 40% of mortgages we were doing, 40, I think, were variable mortgages. Right now, it's down to like 5 or 6%, right?
Wow.
So
So
the consumer behavior is completely changed, right?
yeah,
Which makes sense because the variable rate is higher.
yeah. It's like before, I think from the get-go, it was almost 1% lower, right? The
Correct. Yeah.
levels are lower. So now like 1% higher. So rather so instead of waiting for that 1% to come down, maybe going for a short term, if you have that risk adverse, if you're like if you're okay to take the risk, maybe going for a 3 years term or 2 years term might be a better option.
Yeah. Yeah, exactly. And like some clients still do the 5-year fixed. Like I have clients that go with that, standard like 5-year fixed. I don't want to worry about it as well. So ultimately, you're not going to get 100% of this thing right.
Yeah,
You're not. That's people try to focus on everything being perfect,
yeah,
and it's really really hard to do that. So you're not going to get a 100% of it right. I think you have to go with what you're comfortable with, what you can afford, and is this going to change your lifestyle? That's the payment you go with.
yeah.
That's the term you go with. That's always the advice.
Yeah, and especially if it's an investment property, anyways, whatever the interest that you're, if it's a difference of $50, $100, it's anyways a write-off.
Yeah, exactly.
Okay, so let's take some more questions here.
Yeah.
Jitin is asking, hey Aditya and Pritish, thank you for your time. We are looking to buy our first home, preferably a detached home around 1 million. Another option is keep renting and invest in two investment properties, 600 each. Your advice. Do you want to take on this? Maybe I'll add my thoughts later.
Sure. Yeah. I mean, it's those are so different, those two things, right?
Yeah,
One is you're buying, a home for yourself, you and your
yeah,
family to live in, and the other one is, you're growing your portfolio and your future investment values, right? So it's like a few long-term investments. So it just comes down to what's most important to you right now. Are
yeah,
you looking for $1 million shelter for your family, or are you looking to invest in a property where you feel like the prices are in your favor, right? And so it just comes down to what your goals are.
yeah. And where
I,
you are
I
currently with your, with your life, like how old are you? How, how many years left for you to retire?
yeah,
If I have to give a biased answer, if you're earlier in your stage, if you're, like us at 30, 35, my biased answer is go for the investments first, because build the damn wealth. And you can, because if you're buying a detached home around 1 million, there's no way for you to go invest. You're just having an asset, you have to literally work for it. But that being said, you could be someone who is a business owner who is making good amount of money. You have active income coming in that you can, you're not worried about the money. You can invest anytime later, but your family demands for a house, then yeah. But if you're talking in terms of returns, in terms of having a wealth for you and your family, definitely the investment route makes much more sense. So that's my biased answer.
I kind of knew you were going to say that.
Yeah, because even till the day I haven't bought $1 million home. My house is, I bought it for 300,000. Of course, I refinanced for 600, took the 300, put it into another investment, because I'm 32 and my goal is to have a financial freedom by 40, 45. I don't want to like think about money at all and then go buy luxury, because I have another 30, 40 years from there to enjoy that house. But I want to buy with peace of mind. I want to have a free and clear home, and that time I'm going to build a $1 million home, maybe more, a nice a mini mansion where me and my family can enjoy for the rest of the life and not worry about the finances. Because
Yeah.
now if I have those two 600,000 homes, and those, let's say for next 10 years, I worked my ass off, rented in the place where I am, and I paid those down with that rental income plus my income. Now imagine you have two properties that are worth 1.2 million down the road. And plus, not only that, the kicker is they're making money. I'm assuming at 600,000 home, at least in Windsor, you can make $3,000 $4,000 income. So 3,000, 3,000, $6,000 income plus. But again, that being said, I agree with you as well. Like, we don't know where you are currently with your
Mhm.
life. Every
Mhm.
person has a different goals. Every person is, different in their own way. So, and, every person have a family, different family goals.
Yeah,
So
different needs and stuff. Yeah.
different needs, exactly. So it's what you want is definitely a better question to start with, and then reverse engineer. Going back to some more questions, Capri, just a quick question: what's the variable rate for 5 years?
Well, you know what? I've got my rates pulled up just in case I had any questions today. So around the rate. So the 5-year variable, you're like I said, you're going to be ranging anywhere between 605 to 635. Just depends on the file. So I would say probably right in the middle, maybe around 62. The spread is not there on the variable product, so it's 6.7 is the rate, and then it's discounted anywhere from 40 to 50 to 55 basis points. So you're
So
down,
typical
6.7.
consumer question again: would you suggest variable now or fixed?
Again, just comes down to why are you buying the property? What's your goal with the property, and what are you looking for in
Okay, let's
terms of?
say just me.
Yeah.
Now you're doing my mortgage on
Yeah.
my pre-construction. um, I'm an investor. I have
Hmm.
some, I don't mind taking a little risk,
Yeah.
but I want to save as much as I can.
Yeah, I would say go with like a 2-year fixed rate. Honestly,
Mhm,
I think two-year fixed rate, 3-year fixed rate is a good option. You're
mhm.
not participating in the higher interest rate for the next 12 months for sure in a 2-year. And then 24 months from now, if the forecast from the economists is correct, you're probably going to end up being in around 4.5% range, right? So you would pay
Four
a
and a
little bit
half
higher.
in terms of fixed, or 4.5 in terms of prime rate.
4.5% probably in terms of fixed. The prime rate's also going to drop too, right? So it's probably going to go down by 1 or 2%. With the prime rate and the variable rate, what it just comes down to is what's the discount that the banks or in financial institutions are allowing on the spread, right? There are lenders out there that you can get a variable rate below 6%. Just it varies from case to case, and we price match and do all sorts of stuff, right? But if you're like, again, if you're unsure of what's happening and you don't know, if you don't feel too confident in the interest rate environment right now, go with a 2-year fixed rate. I think that's a
Yeah.
pretty safe bet.
Yeah, I love the suggestion. Sarvesh, hi Aditya, hi Pritish. Question for Pritish. For the first time home buyers making approximately 100,000 per year, what's the best advice and practice that would help them to buy a house easily?
Well, buying a house is pretty easy. You just have to have the income, which is great,
Okay.
$100,000, and you have to save your 5% down payment, right?
Yeah.
So it's not, buying a home is not difficult. It just comes down to savings, income, and then getting your offer accepted, which
Yeah.
is a different scenario, right?
And
Best
also it
practices.
depends on which location you're located,
Yeah,
where you're looking to buy. Because, if you're
absolutely.
in Toronto, 100,000, and if you want to buy a detached home or a semi-detached, good luck to you, I guess, right?
Yeah, it's that definitely location, because the price is determined by the location primarily, right? So,
Yeah.
that's, you just have to save, and if you need to qualify for a higher mortgage amount, the best way to do that is by um, increasing your income. So co-borrowers is a very common practice right now. Friends, family, uncle, aunt,
Find a girlfriend.
cousins, anybody. We have your friend, and like whoever. Like I said, a lot of first time home buyers are actually buying with co-borrowers. And
Yes.
so, if you're looking for if you're looking for advice, that would be it. If you're unable to achieve it on your own right now, partner up with someone, and buy together.
Yeah, I think if I have to add on to that, the first step is focus on saving money. At least
Hmm.
have work on your saving habits, because it's not easy in this consumer world where you will see on your screen every day, buy this, buy that. Someone bought this, someone bought that.
Hmm.
Um, once you first focus on saving money, at least once you have 30,000, which will get you at least a 500,000 home in cities like Windsor. And of course, if you're a first time home buyer and you are working from home, you don't have to fixate yourself in bigger cities. And that I'm assuming that you're in bigger city. um, because you can look for options like cities like Windsor. There's a lot of cities like that. Of course, Windsor is the best one out of that. uh,
Absolutely.
so that's the first step. And second step, once you have some funds ready and you have a full-time job, now it's the time of like literally finding a good realtor in that city, whichever the city you're in, and going for a hunt, going for the shopping. Of course, it's going to take some time, but if you're picking the right agent, they'll guide you where the market is. They'll show you different options. They'll give you ideas on where to buy, where not to buy, how much to pay, how much not to pay, all those things. So pretty much like once you're done with your down payment, once you have your pre-qualification, finding the property is much easier, because now you're clear on your financial terms. And if you don't qualify, like Pritish mentioned, that's when you can go for those
Oh,
joint. Go ahead.
one thing I was going to add was, one thing not to do is if you're serious about buying a home right now, like try avoiding making any large purchases like a car,
Yeah.
right? Like don't do that. That can severely hinder how much you can borrow,
Yeah.
right? So don't buy a Tesla if you're looking about buying a
Yeah.
house right now, So but so yeah, just try to avoid large purchases like that. Another thing that happens a lot, what I see is with house shopping is, they have those deferred payment loans. Like
Mhm.
Best Buy has like no payment for 3 years, or like your furniture store may have no payment, no interest for a few years. So you buy that thing thinking it's not going to impact your debt servicing, but even though you're not making any payments for 2 or 3 years, we still calculate that. So like avoid big purchases. And the on the opposite end, some people never use credit. They wanna have no use credit, but use it in an appropriate manner, right? So use
Wisely.
your yeah, use your credit card, but pay it off. So show that you know how to utilize credit, because
Yeah.
sometimes a lot of first-time homebuyers I see, they have very thin credit history. They might have like one credit card, they barely use it. So you wanna try to build a case of, you know how to utilize credit, you're not misusing it, and you also want to avoid any large expenses or having large monthly loan payments that are going to take away from your ability. So that's another good practice. I would say avoid those things if you're about to enter the market.
Yeah. And Pritish, I was laughing because when you said don't buy a car, I made a reel saying that don't buy a car. How many people jumping on me left and right
Oh,
till the day. You're crazy. This guy doesn't know what he's talking. He's just stupid. He's not in Canada, because how can I live without buying a car in Canada? Bro, I'm not saying don't buy it all. Like, yes, that I
yeah,
made that
yeah,
exaggerated, but the reality is like you don't have to put mortgage on it. If you have
yeah.
5,000, 10,000, you can buy a freaking used car.
Hmm.
So that way you don't have any debts because of this. The ratios, the qualification ratios has became so bad. Like if you're making 100,000, 2 years ago I would have qualified for 500, 600,000 mortgage. What do
Yeah.
you qualify now?
4.
For that is assuming that you don't have any loans.
Yeah,
That is what I was referring to. Like
yeah.
make sure you have a clean balance sheet. Don't
Yeah.
go for that crazy loans. And
Buy
I
that
heard,
after. Buy that later.
yeah, after I bought my Tesla after what, like I started investing 6 years ago.
Hmm.
After having at least, if I just pull my accounts here and there, I will have $1 million somewhere.
Hmm.
That's when I bought my Tesla. Until then, I was buying cheap cars. Like my last BMW, it looks like BMW, but it's 22,000 or 23,000 car. And that I bought because I made one sale that was worth it for that amount. That's when I got my car. So until then, I used to drive Honda Civic.
Yeah.
So
Yeah, I drove a Ford Focus for like the longest time.
yeah,
And even now, like I have a family car. I have a Ford Edge.
yeah.
The so yeah, focus on what assets you want to invest in, right? So
And again, this is the thing, right? Like I would ask, let's go back to and ask you a question. If you're here, not you, the person
mhm,
asking the question, if you're here listening to real estate talks, I'm assuming you're interested in real estate.
yeah.
Doesn't matter what you say outside, at least somewhere deep down you want to have some assets. So of course, when you want to have some assets, do the delayed gratitude. This is something that I tell my agents all the time. Like, my cousin, he started to make money now, and he's a big spender, and I've been telling him every day, at least once a week, we have discussions. Don't buy that shit. Like, he knows that I'm gonna literally scold him, or even slap him. That's why he didn't even tell me, and he went and bought a car.
Oh, what did he buy?
He bought a Mustang, and that
Oh,
convertible.
oh, I saw that. I saw
Yeah.
that. He bought that?
Yeah.
Oh man, that's a nice car though.
that's
That's
a
a nice car.
that's a damn nice car. I loved it. Like, I drove it, like, but again,
That's awesome.
look, at the end, for him, at least, he rewarded himself because that month he made 50,000, just that month. So he
Wow.
said that and he got a good deal. He bought it for 25,000. So he's like, okay, at least I will forgive you if you make another 10 sales, and that is enough to buy another property. But again, go back to your needs, right?
Yeah.
Your desires. What is more important for you? And everyone on social media, if you are following people on social media who shows off their cars, shows off their houses, don't give a shit about that. Even if you see me on my Tesla, look, I put in hours, hundreds of hours, behind me, and I own a bunch of assets that, literally, if I have to, I can pay off that right away with cash. um, so don't look at people like that and buy things. First, accumulate the wealth. If you really want freedom, accumulate wealth first, then use that, assets to buy the luxury shit that, you don't have to worry about. What if you lose your job, right? So that's something I thought of, I would
Mhm.
pick on, definitely. And going back to some more questions here, Sarvesh, again, another question to Aditya. Okay. First time home buyer who is living in an expensive area like Toronto, would you suggest a house hack or burst strategy in a relative cheaper areas like Windsor? There you go. You're already thinking.
Yeah.
So the first question is, forget about burst strategy. If you're looking to buy a home, the first time home buyer, you're buying itself, the primary. If you buy it as a house hack, like you're mentioning, a duplex, live in one unit, rent out the other unit, and if the duplex in Windsor, probably you can get around 500,000. So that itself, the purchase a primary home itself is a burst strategy. And I'm going to repeat again, the purchase itself is a burst strategy, because the goal of a burst strategy is, if you don't know, someone watching, if you don't know what's burst strategy, I'm going to just briefly explain, and then I'll tell you why the primary home, a house hack, in a smaller city, a property under 500,000 is a burr itself, without doing any renovations, without going through any hustle, without refinancing. Just the purchase has itself is a burr. Here is why. The burst strategy means buy something that need some renovations, do the renovations, buy, renovate, and then rent it, and then go put a new refinance, like new loan on it, so that you can take your initial investment plus your renovation money. So the goal of the burst strategy is to have your capital back, so you can go and reinvest again. So that strategy came into play and became so popular, especially when you're buying an investment property. Because for an investment property, the minimum investment is 20%. If you're buying a 500,000 property, at 20% on 500,000 is 100,000. If you're just buying and sitting there waiting for the market to appreciate, that means you're 100,000 stuck in a property. And that's when the smart investors came up with this idea of forcing the property value by doing renovations, by doing some creative renovations that can increase the value. But the primary home, the house hacking concept, especially if it's a duplex or single family under 500,000, All you need is 30,000. So that means your money is not that much into the deal. Even a perfect burr, sometimes we leave some money on the table. Here you go. You're getting a secure, high ratio mortgage with a lower interest rate because it's an insured mortgage. So you don't have too much money into the deal. Now buy this and forget for next 1 2 years, because now you don't even have to refinance. Your money is not that much into the deal. Save up more money, because now you're house hacking. That means your cost of living gone down. If you can, like city like Windsor is the best place in my opinion, because I cannot imagine myself owning this much properties if I would have been in Toronto. Would you agree, Pritish?
Yeah, no, it's totally different game over there, right? So Windsor's still like from this size of a city perspective, most affordable. It's the
Yeah.
most affordable.
And with the growth potential,
Yeah,
I've been
absolutely.
talking about the Windsor growth. Everyone who follows me, they know that
Yeah.
what I talk. What is your take? How are you
But
seeing? What are you seeing in Windsor happening? What's your predictions on the future of Windsor?
Absolutely. I mean, we have so many projects going on, right? Like you said, you're covering it off. We have, the battery plant, the bridge, the mega hospital, the Amazon fulfillment center. Like I can just keep going on and on. There's so many positive things happening, right, in Windsor. And you have to think long term. For something like the battery plant, if you fast forward 5, 10 years, that's going to potentially create an additional 10,000 jobs because of all the other manufacturing establishments that are going to open up, other businesses that are going to open up. So there's so much happening in Windsor. So I still think, one of the things I truly believe in, I always try to tell all the clients is, people are so fixated on the rate, right? Everybody talking about the rate all the time. But the rate is only temporary. The rate is not forever. Okay. You're going to pay this rate for the next few years, and then it's going to go down. And then over the span of your mortgage, it might go back up and it might go back down. But the price you pay is forever.
Yeah.
So what would you rather, for me, it's like, what would you rather do? Would you rather pay a lower price? Because once you pay that price, it's forever. Pay the lower price with a little bit higher interest rate, which is not forever. Or would you pay a higher price, again, forever, with a lower interest rate, which is not forever? So I would take the lower price with a little bit of higher interest rate right now. And so I always try to tell clients and investors, buyers, whatever it is, don't get fixated on the rate. Look at what's happening in the market, the local market in Windsor. Look at all the positive things that are happening, and look at the prices that we're paying compared to a year or 2 years ago, right?
Yeah, love that, love that. Let's take some more questions here. We're already 7:55, so this lives are always short for me. Time
Yeah,
just
it's
flies.
flying. It's flying
Yeah.
by.
So Harsha is asking, in case of systematic credit risk event, big US banks running out of money, will the rates go back to sub 2% level?
So good question. One of the things you have to always think about is they don't want to overstimulate the economy, right? So right now the US is in a bit of a conundrum. If they start reducing the rates right now, it's almost like a bit of a panic because of what just transpired. And if they reduce the rates too fast, it's going to overstimulate the economy, and so inflation will go up faster than they anticipated. So I wouldn't say never. I'm not going to say no, never. The rates will go below 2%. No, but I don't see them doing that, for a while, unless it's absolutely like an emergency, and they have to overstimulate the economy because they're in such a deep recession. So that's the conundrum. I'm not going to say never, but I like they just increased by 0.25%. I think to show that they're not going to panic and they're not going to start decreasing the rates right away.
Yeah, that makes sense. Robert, hey Robert, welcome back. So Butler Mortgage offers me 4.49 for 5 years fixed, or 4.79 3 years fixed rate today. So what's your take on that Butler Mortgage, or what's?
Yeah, I mean, look, there's a lot of mortgage companies, right? You have to look at, just again, like I mentioned earlier, look at all the fine print. What does it allow? Are there any restrictions? Yeah, like the rate's very appealing, but always, like I said, make sure it matches with what you're trying to accomplish, right? Is it flexible? Is it not flexible? And don't be afraid to ask your lender. Like if it's me, for example, don't be afraid to ask or give us an opportunity to match. Because remember, someone like a mortgage specialist is restricted by whatever their organization's rates are. So if my organization's rates are 4.79% for a 5-year, for example, and you're shopping for the 4.49 at Butler, yeah, just let us know. We're happy to try to match. And ultimately, if we cannot match and that mortgage has everything that you need for your mortgage needs and it fits your criteria, obviously you're going to go with that option. So, I have nothing, like I said, that's pretty much my take on that situation.
That makes sense. And here, this is a great question. Has employers are calling back to the office, at least hybridly? What is the communicating distance lenders would look for mortgage approval?
Good question. So, again, it's a little bit case by case. Do we have clients that can commute, several hours? Yes. Do people do it in GTA? Absolutely. People take the GO train or take the subway. It takes and they live further out from the city, right? So we don't have like a definitive limit now. As long as it's reasonable and it's plausible, we're willing to work with that client in that situation. Obviously, if you live in Ottawa or you're moving to Windsor, but you're working hybrid in Ottawa, that's going to be a little bit tougher. But we have done situations, where the hybrid situation is GTA area, and they're buying a property in Windsor, and it's a hybrid situation. As long as we have a plan or you have a route that you're going to be doing or using, it's it's doable. We've gotten those files approved.
Got it. And hybrid could be like 1 day in a week.
Yeah, it's one or 2 days. It works. Again, it's not it's not out of the realm of possibilities.
Yeah, and it's not a bad drive. 3.5 hours, 4 hours, once a week. Maybe it's just one ride. You can get out of the stress and enjoy some podcast live like this.
Yeah. I mean, one of the questions you just kind of want to think about is more about, where you'll stay if you have to do hybrid for more than one night, right? So, where will you be staying when you go to visit? Sometimes you have family there, so that's where usually people will stay, is with their family.
Yep. I think some comments is between each other. Probably, that's good. I see people are communicating each other, having some question. Sarvesh, fair point. Starting hunting in 3 years from now. I'm too young for it now. I mean, for real estate, it's never too late, never too young. It depends on what your goals are. If you're standing here asking questions, maybe you have something deep inside. It's all about like, do you have status? Do you have permanent residency? Do you have some saved up money? Because this real estate is a very, very thing that everyone thinks, okay, I wish I should have bought 5 years ago, 3 years ago, 10 years ago, because time will just fly. Focus on your career, definitely. But if you can buy one property and just have it managed by professionally, and that will take care of for itself, and you forget. At least you just manage your once in a week, once in a month, couple of hours in a month, just to check all the financials, just make sure it's running smoothly, and go with your hustle hard. So by the time you're ready to make kids, you'll have good amount of wealth sitting there that you can have a more freedom in life. So any last thoughts, Pritish, before I let you go?
No, just thanks again for having me on here. Hopefully, that everybody enjoyed the session, and I'm looking forward to our next one. And as always, thanks, man, and keep up the great work.
Yep. Thank you. And then here, one last question from Robert. Any thoughts on CDIC raising deposit insurance? 100K seems too small, even if you're different category. What are the odds they go to 200K plus?
Yeah, I mean, like they're always looking at those types of policies. You do make a good point. It's 100K, different categories, so you can have up to $400,000 or $500,000 in one financial institution. So they could possibly revisit that because of what's happening in the U.S. They have the 250 there. Ours is 100. So again, multiple categories. You can go much higher than 100,000 per financial institution. So yeah, they could potentially revisit that if needed.
Yep, that's a little dry subject for me. I have no clue what you guys are talking. but I just nod my head. Yeah. But how that is going to impact on a normal person, like, honestly, I didn't understand what you guys.
So CDIC raising deposit insurance. So what that is pretty much like, let's say if your bank failed and you had $200,000 in a bank account, let's just leave it at that, no other assets, they would only cover you up to $100,000 of that
Gotcha.
200,000. Okay, and so that's what he's asking, if they're going to increase that. There are multiple categories you can have the 100K in, but
Gotcha.
right now it's 100K.
Okay. So that's why, I never keep any savings in my bank account. I'll just invest back into multi-families, single families, cash flowing properties.
There you go.
That's why I invest.
That's
Why
it.
to keep it? If you are keeping in the bank's account, they're just investing for you.
Yeah.
But yeah, jokes apart, bro, always a wonderful chat with you and a lot of insight about mortgages and different things. And how people can reach you if they have any more questions about, mortgages. And I'm
Yeah.
assuming you do mortgages across the province.
Yeah, across the country, Alberta, BC, anywhere. Yeah, no problem. Just I try not to do anything in Quebec because they have different rules there.
Mhm.
You can definitely reach out to me on my Instagram. So it's mortgage.mastermind. Again, mortgage.mastermind. That's my plug. If you want to reach out, you can DM me. My contact information is on there as well. My phone number, email, whatever you need. And we always offer free consultations, right? So if you want to get an opinion, you can reach out to us, and hopefully we can put a nice plan together for you.
Yep, sounds good. Thank you so much, Pritish. And guys, of course, you know that if you need any help in Windsor, we are here. But also, just a one serious note: if you're someone, a landlord in Windsor, who owns properties in Ward 1, Ward 2, or even just in general, you owns properties in Windsor, or you're a potential, person who is going to invest in Windsor, DM me. I want you to participate in this new rental licensing that is, right now implemented on Ward 1 and Ward 2. If you don't know what is all that, I have another live that is a 1 hour session about rental licensing in Windsor. But if you're opposing that and you want to, fight with the city, I mean, not physical fight, just do a petition. We actually have a group that we are actively chatting what to do, and actually planning to have a lawyer soon on Friday, on Sunday, meet up with other landlords and investors here and realtors, to fight with the city, asking them to revoke it or make some favorable ways to have some better faith for better ways for the investor. So if you're someone like that interested in to be part of it, just DM me on Instagram. It's my full name, Aditya Kumar Soma, on Instagram. Just saying, hey, I want to participate in this uh, mm, petition. Just DM me. I'll send you the links to join the WhatsApp group and also to file for the petition. So with that, thank you so much, guys. Have a wonderful evening. Thank you, brother. Have a good night.
Thanks.
Take
You
care.
too. See ya.
Bye.
Bye.